Hello investors, welcome to Proceemo, the value stock analyzer. Today is January 30th, 2023, and we're covering Apple Inc. Apple stock is such an interesting one and has been for the better part of the last 2 decades. In fact, if you had invested $1,000 in Apple stock in 2003, you would have 3,703 shares, which would be worth $540,481 today. Wow, coulda, shoulda, woulda. There's a lot to like with regard to Apple as an investment. Things like revenue growth, profitability, and a diversified portfolio. Those are just some of the reasons. Let's get into it. Don't forget to like and subscribe. Your support will help us continue making content for you. And please check out Proceemo.com to see the following analysis for yourself. Normally in these videos, I go into a short history and description of the company because I want you all to understand the story and how important that is as a potential investor. I'm not going to do that today because, well, everyone on planet Earth knows Apple. They are one of the most iconic brands in the world, if not the most iconic. Their story has been told before many times, again and again, and honestly, any company with an association with both Jeff Goldblum and John Hodgman, well, that's just legendary. Apple is trading at $145.93, up from the 52-week low of $125.02 on January 5th, and down from the 52-week high of $178.96 last March. Year over year, Apple is down 15.22%, and that's really because the entire market continues to be down on high inflation, high interest rates, recession fears, war in Ukraine and Russia. You know, the normal stuff. Apple is very profitable with a nice price to earnings ratio of 23.88. This means they have an earnings per share of $6.11 and they have a dividend. The most notable thing here is the non-typo at the bottom of this table. Apple's market share is $2.3 trillion. I know money seems to get really abstract for most of us after $1 billion, but to put this into a maddening perspective, Apple's net worth of $2.3 trillion means if Apple were a country and that were their GDP, Apple would be the 8th most economically abundant country in the world, just ahead of Brazil and behind France. At $2.3 trillion, Apple is the most valuable public company in the world. Before we get to revenue, earnings, and growth, let's take a quick look at the book of business. Apple is not a one-trick pony, although one of those tricks does make up half of its business. That trick is the iPhone, a device that has only been on the market for about 15 years and accounts for $205 billion of revenue for Apple. Taking a step back for a moment, if we think about tech startups getting to $1 billion in revenue, this is one of the most incredible milestones a startup can hit. Most startups don't even get to $10 million in revenue, so $1 billion is really something. $200 billion in 15 years is almost unprecedented. Facebook, one of the world's most successful startups in 20 years, just broke $100 billion in revenue. Google broke $200 billion in 2021 when it was about 23 years old. Microsoft, one of my favorites, is just breaking into the $200 billion club nearly 48 years after it was founded. The closest I could find was Amazon, which did break $200 billion 24 years after it was founded, but they sell a lot of stuff at lousy margins. In fact, when they broke $200 billion, they were only a couple years into seeing profits, and their margins at $200 billion are a tenth of what Apple's margins are. This is a lot of comparison, but it's important. Not only is the iPhone an incredible revenue generator for Apple, it's also wildly profitable. Things that generate a lot of cash are not usually very profitable. Walmart, for example, generates a ton of cash. They bring in over $500 billion a year, but the margins suck by comparison. However, at Walmart scale, the margins can suck and still be a nice return on equity for shareholders because the volume and execution of that volume is very good. The iPhone generates almost a third of what all of Walmart does in terms of revenue and still produces nearly 3.5 times more profit than all of Walmart. Apple has an exception here. It's not the rule. And the iPhone is only half of Apple's business. Apple has its computers, which make up 10%. Wearables like the watch and AirPods is another 10%. The iPad is a measly 7.4%, which is still nearly $30 billion, by the way. And finally, services, which make up 19.8%. These services are Apple TV, music, health, news. It's the subscription arm of Apple, and the investing world loves tech subscriptions right now. They are very profitable and tend to be stable sources of income. All this to say, Apple is very well diversified. Coming down to implied growth, we see 8.16%. Implied growth is a calculation that tells us how much growth is baked into a stock based on its current price and earnings. It's not a crystal ball, it's merely a value calculation that some folks use to see where a stock is relative to where the market thinks it's going to be. 8.16% is saying that only modest growth is baked into Apple's stock price at current levels. Coming down to revenue, we're at $394 billion in annual revenue as of September 2022, an increase of 7.79% from 21. 5-year average revenue growth is 12%, 3-year is 15.52%. So 21 to 22 was a slower than average year for Apple. More on that later. Earnings for Apple are really great. On that $394 billion, net income was $99.8 billion. Those are really great margins at this scale. Earnings growth from 21 to 22 was lower at 5.4% relative to the 5-year average of 18% and 3-year average of 24.74%. While historical revenue and earnings are strong, it does look like there was some resistance in the latest annual report. Well, there are a couple factors here. First, iPhone sales were not as high as they expected. Only 8% growth from 21 to 22 for the iPhone. Overall sales slowed with higher inflation and higher interest rates. The most interesting factor, though, is the currency exchange rate. The US dollar was and continues to be pretty strong right now in the world, which, if you only hold US dollars, is very good. Apple does business all over the world though, so converting those foreign currencies back to US dollars hurts a lot. By Apple's math, their revenue growth could have been closer to 14% instead of the 8% had it not been for the strong dollar. Checking out the scorecard, implied growth over 5-year actual growth is 0.45. We say 1 is a perfectly priced stock. Over 1 would mean overpriced. Under 1 would mean underpriced. Here we are under that 1, which means by the implied growth calculation, we have some room to grow. Liabilities over assets is interestingly high, 0.86. We say a healthy range is between 0.3 and 0.6. At 0.86, we would say Apple is slightly more leveraged than it ought to be. Apple is not afraid to borrow money, especially when money was cheap. Luckily for Apple, they do have a strong balance sheet, lots of cash, lots of assets. We're not worried about this being a little high. Steady dividend is true. Let's take a quick look. Over the last 10 quarters, we see dividends grow from 21 cents a share to 23 cents a share. So a 10% increase over 2.5 years, that is good, but this dividend is very low, less than 1% yield. No one is buying Apple for the dividend. Back to that scorecard, we can see the dividend ratio is over 8. We worry a company may not be able to sustain a dividend when this falls under 2. Ideally, it's around 4. At 8, this tells us a couple things. First, the dividend is very safe. Second, they could be paying way more of a yield. They choose to invest in themselves instead of paying shareholders. Respect, Apple. I like it. Coming down the list, 5 years of increasing revenue is false. Between 2018 and 2019, before the pandemic even, Apple revenue actually came up short on an annual basis. Assets greater than 120% of market cap is false. Unless you are a country, it's going to be really difficult to have trillions of dollars worth of assets right now. Apple is not close. They have about $200 billion worth of assets. 3-year average revenue growth is greater than 10-year average revenue growth, which is impressive given its size. Momentum is on their side, which is saying a lot for a company as large as Apple. Market cap over enterprise value is nearly 1, which would suggest the stock is almost fairly priced. How do we summarize Apple? I have been watching Apple as an investor for the past 10 years in awe. I've never bought a share, and that's shame on me. Even if I just bought some 5 years ago, I would have more than tripled my investment. Every time I evaluate the stock, and this is going back 10 years when I started doing this type of technical analysis, the analysis always says the stock is undervalued. Even today, the stock is undervalued by many of the technical indicators that we use. And yet, my gut tells me they can't keep growing like this forever. And to be absolutely sure, they can't. But could they grow 5 times over from where they are today in the next 10 years? Yeah, probably. I don't know what the top is for Apple, and maybe that scares me as an investor. Maybe another way to think about Apple, what would it take for Apple to start losing? Well, someone would have to disrupt the iPhone first and foremost. Even if sales and growth slow, the iPhone business is still a $200 billion cash machine. Then they have AirPods, which literally are sold in vending machines. We lose these things, the batteries start to really suck after 2 years, and we just pick up another pair like it ain't no thing. That's a massive business that has high return rate of customers. And that services revenue. Apple has nearly 900 million active subscriptions across all of its services, and it feels like there's still room to grow. I guess to answer my own question, or not answer, I don't know how Apple loses. In 5 years, I will probably regret not buying Apple at $145 a share and make another video just like this on the 4th MacBook Pro in 5 years. That's it for today. Please like and subscribe if you found this helpful, and if you really want to support the channel, please go to Proceemo.com and subscribe to our monthly service to see analysis like this for yourself for only $5 a month. And if you have a stock you'd like to see featured, please comment below. Thank you, happy investing, go find some value.